Welcome to the All About Alts podcast, where we explore the world of alternative investing to help you find financial independence. Join our host, NuView Trust's president, Jason DeBono, as he covers a variety of topics with different guest speakers to discuss tax and alternative investing strategies. It is never too late to start taking control of your financial future, and we are so excited for you to be joining us for this opportunity to hear from some of the best in the business.
Hey, everybody. Welcome back to the All About Alts podcast. I am your host, Jason DeBono. Excited to be here. We've got a great guest today, a former infantry combat veteran of the Marines. Thank you, Michael, for your service, but just an absolute pro in the private lending space as well. So we're going to talk about all things lending, both on the commercial and residential, as well as the traditional and the private space. So a lot to cover today. Michael Aubut, MoneyStream Financial. Great to have you on the show. How are you?
I'm doing great, Jason. Thank you so much for having me today. It's a pleasure to be here.
Well, you know, I always love good stories and backgrounds, and going through Michael's was another one where I'm always like, gosh, how the heck do people find time to do all the things that they do and accomplish all the things that they've accomplished? And at the risk of maybe making Michael blush, let me just share some highlights so we know kind of the pedigree of who we're chatting with. I mentioned 10 years in the Marine Corps. Michael, thank you for your service. And I'm sure there's a lot of that 10 years that plays into your personal and professional life every day as you continue to move out of kind of the service and into a professional career. 20 years in lending, including both traditional loans and private loans. Serves on the Political Action Committee for the Florida Association of Mortgage Professionals. Sits on the boards of nonprofits, and somehow in all of that, he finds time to eat, sleep, and do some of the normal, casual things that people do. But what you got a lot going on, Michael, and if that's not enough, you also run MoneyStream Financial.
Fortunately, I've got a good team and a lot of support. And, so I look at the opportunity to serve as not just maybe what someone might do in the military. For me, for example, the Political Action Committee for the Florida Association of Mortgage Professionals is an opportunity to serve our industry and the consumers. And, the nonprofit activities, it all kind of plays together. I don't have a separate private and personal life, if that makes sense. I love what I do. And so I'm able to dedicate time, and I have a very supportive staff and a supportive family.
Well, those two things are certainly critical, and those things don't happen by accident, right? I'm sure a lot of deliberate efforts goes into building that. And I think that's something we talk about a lot on the show is, what are you doing to build your personal and professional career? And I think it's interesting. I love what you said. A lot of people kind of feel like it's work-life balance and it's post-COVID and, life comes before work. And I really appreciate the sentiment that it created, but I wholeheartedly disagree that those two things are mutually exclusive. I think people learn that they don't need to work 100 hours every single week, and they can cut that down and we can be more deliberate and productive. But work and life go hand in hand. They almost have to if you're trying to build a career and build a business, because you can't just wake up and do this when it's convenient. You're taking calls and fielding calls from whether it's your team, whether it's your clients, 24 hours a day. And on a good day, we get it to 12 or 14, but the needs and wants of our consumers don't go away. Yeah. And that's the beauty. But so let's start there. You started originating loans back in 2000. So, entering into the nearly 24th year of kind of being in the industry, and you've worked your way, up into building a company, which is super cool. Love that story, because I think a lot of people, they may be starting a career and they don't make it their own, right? Not that everyone has to. So let's talk a little bit about that. Kind of what was, that point where you said, hey, I know enough about mortgages and I'm willing to take that leap and start my own company and kind of build my own lending business. What was there an epiphany that happened? Was it an aha moment, or was it just kind of an organic thing that slowly happened and you're not quite sure where it started, but here we are?
I think it's like a lot of things in our business and our careers, it's an evolution. I was really fortunate when I got out of the Marine Corps and I ended up getting a master's in finance. I really had no idea what I wanted to do, in terms of what aspect of finance. And I ended up falling into an opportunity by happenstance, where I was working with an incubator, which is a firm that's established for the purpose, and this one specifically helping women and minority-owned businesses with the success. And so they were a full spectrum firm, and they had a CPA, they had an attorney, they had legals, and so on. And I came in specifically with the task of helping arrange SBA for a business startup. Might mean creating the financials and the projections, helping them through that process. And then during tax season, helping with overflow tax work. And, so it became, I guess it gave me a very wide base. And it was a smaller firm. So there was not, you walk into and here's your job description. In this case, my job description was whatever had to be done at the moment. So I developed a slightly more rigid environment, being in the military for about 10 years. I went in when I was 17. So my formative years were military and infantry at that. So all of a sudden I was in this very entrepreneurial environment, and very flexible, and kind of something had to get done, you just figured out how to do it. So I learned a lot. I learned not to be afraid to take risks, and back then there wasn't quite so much Google, as we have today. But I learned how to do legal research or paralegal research or tax research to figure stuff out, and that's really served me well. And if I was ever going to talk to a younger person thinking about what they want to do in their career, I guess the first thing I would say is never sell yourself short or put yourself in a specific box. Explore, grow and explore, and have that entrepreneurial mindset. Even if you're working for a company, have that entrepreneurial mindset.
I love that advice, and it's spot on. Too many people today, they want to know where the box that they operate in, and it's like, if you want to put yourself in a box, you're never going to get out of that box. And it may sound really good, and role clarity is important, but being able to do more things and cut your teeth, sometimes it's just the overcoming the fear, and challenge of it. And if you're going to be a business owner, you better learn to do everything, because there is no as you grow your business, you can start to delegate and elevate and put people in a position to take some of that stuff on. But, I'd be willing to bet, even with a great team today, you're head cook and bottle washer, and it just depends on the day as to where the needs are. And you got to be able to, is it adjust, adapt, and improvise? Is that am I getting that right?
Improvise, adapt, and overcome. Improvise, adapt, and overcome. And yeah, that's a good old movie quote that, from that, what was it? Heartbreak Ridge, right? With Gunny Highway, Clint Eastwood. And that's become, I don't think that's automatic for most people. We're not bred that way. We don't grow up in school to improvise, adapt, and overcome. You grow up in school, you're trained to find the right answer and, solve that specific problem. And, so I think that learning how to stretch your mind and stretch your roles is a big part of what allows people to become more successful. And, maybe in an entrepreneurial environment, but I would argue that if you work for a company and you don't have an entrepreneurial mindset, you're making a mistake. We're all self-employed at the end of the day. We're all self-employed. Even if you have a company, it's still you. It's franchise you.
That's right. Well, and that moniker of think like an owner, it does matter, and when you start to think like an owner, your mentality shifts. And it doesn't mean that you can understand exactly how the business runs and operates, or that thinking like an owner means you become the owner. But it's a good place to start. So let's talk about, let's carry forward this stories, right? So you're in this kind of an interesting place. You're on the incubator side, right? You are working for a company that's helping people start businesses and working through that process. And I'll just say, I think incubators are amazing. And I think anyone considering going into any business or starting a business should be taking advantage. A lot of these resources are free. To a lot of people are very low cost. So just a shameless plug for incubators. But so, how did you end up on the lending side, and how did you kind of end up with MoneyStream Financial and kind of starting that? What was the impetus behind it?
Well, I had the opportunity to maybe have a forced change. There was a change in ownership in that firm, and reality changed. It was about 2002 ish. It just became a very maybe mercenary type aggressive thing. Try to turn a profit on every activity. Which I don't have a problem. I'm a capitalist, and I believe in, we are all here to make money. But at the same time, it was the mentality changed, and like where it was going. I had a very close friend who was at that time a retail residential mortgage originator, working for a lender. And just over some drinks, he's like, "Hey, why don't you, you're doing these SBA loans, you have this financial background, why don't you come work with me?" So we, I jumped 02, FHA, really just learned there was a T in the word mortgage, kind of, had no mortgage background aside from doing SBA, and they're very different things. And so I got started, and about 6 months in, and about 6 months in, tragedy, he got cancer and died over a period of about a month and a half, just from feeling sick. It was respiratory. It was in his lungs. To the funeral was about a month and a half. And so I learned a few things about life at the tender age of in my early 30s, about the take every moment. And that was a big philosophical understanding for me. But from a business perspective, I discovered that, because he was the one who kind of had the inherent knowledge. So I was now going to the branch manager and saying, okay, do this. And the branch manager's answer was always to reach behind him, grab a binder off the shelf and say, yeah, that, read this. And it never told you, never had the real information. So taking the entrepreneurial mindset, I went to school, a mortgage academy, where I went for 6 weeks in Atlanta. I live in the Orlando area. So I went up to Atlanta for 6 weeks, attended this resident course where I learned originating, learned processing, underwriting, sales, and marketing. And up until that point, my mentality was that I was not a salesperson. I was a financial professional. And so I discovered that sales is part of it. And so I evolved and changed a little bit my mentality. And as I was trying to grow that mortgage business, interestingly enough, I discovered one, that you are always self-employed, because it was commission, type work. You're always in sales. And the other thing that I learned is that not to be a commodity. If you do what everyone else does, and if you're the same as everyone else, then you're in a bidding war. You're a commodity, right? I can get gas at the Wawa or the 7-Eleven or the Circle K. It's all pretty much the same. So which one has the best price is where I'm going to go. And so I developed a mentality of being being more of a financial advisor, being people with the big picture, understanding the implications of this mortgage transaction, which for most people was their biggest asset, their home. And for most people, it's their biggest liability, the mortgage that they have on their home. So, kind of helping them plan that in the bigger spectrum in a holistic viewpoint. And so over the years, that kind of evolved. Again, I had a lucky break. I own at the time. I started doing that. And as I was getting out of the Marine Corps, I was buying and selling and flipping. I was selling a house that I owned. I knew about the mortgage world, obviously, because I was in there. And so selling a house, this was back in the old days, right? In like three maybe, where you'd sit at the closing table and everybody was there, realtors, sellers, buyers, they're all there signing their documents. And I didn't have a realtor representing me. I just put it on the, listed it for sale. And the buyer had a question about his loan. It was one of those exotic, if you remember the subprime days,
Oh, yeah.
it was a little bit of an odd loan. And he's like, I don't understand what I'm signing. The closer from the title company is not allowed to explain it. I mean, she tried to answer some questions, but she was, tiptoeing. His realtor was trying to answer. She didn't know. And so he's trying to call his mortgage broker. Can't get a hold of the mortgage broker. Now I'm seeing my closing fall apart, and I'm getting nervous about, I really want this transaction to close. So I pulled his realtor aside and I said, hey, listen, I do have a mortgage background and I'm comfortable explaining the logistics of this specific type of loan program, if that's okay with you. And she said, absolutely, no problem. And so I walked him through it. It was what was called an option arm, which sometimes they called it a pick a pay back then. You could pick your different payment amounts. I explained it. Closing went through. After closing, the realtor said, hey, gosh, I've heard of that loan. No one's ever explained it with such simplicity and clarity. Can you write a little article about that? My husband publishes a magazine. So I wrote a little article. Got put in 6 different magazines for, it turns out her husband was a content provider for several big investor and public speaking groups. Some of those names you would probably recognize, like Tony Robbins and Zig Ziglar, Trump University, the Robert Allen Network, and so on. And so she said, would you like to, would you keep writing article for us once a month? And so of course I did. And I started getting invited to these events, and they would send me an invitation. I'd get a call. The first one was in Vegas, and I didn't have a lot of money. I was, really just kind of starting out. So I get this call, and they're, hey, this is so-and-so from such and such group. Wondering if you would be interested in coming to speak at an event in Vegas. We expect there's gonna be about 4,000 people. You'll do some breakout sessions and that sort of thing. So long story short, I'm thinking, oh man, I don't know if I can afford the, how many nights in the hotel. I'm trying to do the math while I'm on the phone. I didn't want to say no, but
Right.
I'm trying to figure it out. And then she said, so I'm like, well, I have to check my schedule. She said, well, let me know, because we're going to need to make your reservations, and reserve your plane ticket and all that stuff. And I'm realizing, oh wait, they're going to pay for all my expenses. So that was how that started. I started going to these events, generating kind of a little bit of a global following. And back then you could do residential mortgages anywhere. And I put my residential mortgages through a large national bank that I was a branch manager for. I was the only loan officer in the branch. I owned a little commercial building. I had 6 offices in this little building. They rented 3 of them, one for me, one for my processor, and one for my 2 assistants. So I owned the building. I was collecting rent, being paid for me to use my own space. And so it worked out pretty well. It was an interesting path. And of course, 2007 and 8, the lending world changed dramatically. So my focus had been construction loans and investor loans for the most part, because that's what the appetite was at types of events. And then of course, they say 2008 was the crash. For me, the crash actually happened in December of 2007. My entire pipeline of business dissolved because that was the type of lending that it was. And when that happened, I had to make some very fast adjustments, moved back quickly into, private and hard money and SBA, focused on that, which we had been continuing to do, and evolved. As a matter of fact, in 2008, I swore I would never do another residential mortgage again in my life. Never say never, because we still do them, but it's a very different model for us now.
Well, anyone that's been in real estate in any capacity has certainly seen the world change. If you started in this anytime after 2000 and you went through kind of the crash, it was I won't say unprecedented, because I think history, continues to repeat itself. But it was just unprecedented in the fact that everything just came to such a screeching halt. It seemed like literally overnight. And I started in this business in 2005, and I remember 2007, vividly, in 2008, and on the lending side, I mean, you saw it even further ahead than most people. You're a very strong leading indicator of economics, which tells us a lot about if you're not getting loan applications today, you're not closing properties in 30 days, right? And so you're a little bit further out in front.
Right.
So you really saw it from ground zero. Let's fast forward and just maybe wrap this kind of first half of the show up with this question: is fast forward to 2000 and we'll call it 2020, January, February, right? Pre-COVID. And walk us through, as a lender, you had the first kind of catastrophic thing that occurred to everybody, which was COVID. And, as much as everybody thought that was going to be, the recession driver, real estate was going to, go to hell in a handbasket, the market was going to crash, businesses were going to implode. I mean, it was a scary time. And you couple all that with all the health related issues that we were learning as we went through it. Yet real estate did the opposite, right? Real estate took off. It was like it was like a rocket ship that was already midair, got an entirely new thruster and just shot through the moon. And then interest rates start climbing. So walk us through that. What have you seen? What's been the behavioral patterns of kind of the consumer, and kind of where do you think we are today? What inning of this game are we in, and where are we?
It's a great question. So interestingly, there's really two different markets that when we say lending, there's really residential, and then within the commercial subset, there's even some granularity in there. So first off, January, February 2020, obviously that was pre-COVID. Things were normal, right? Rates were normal. Things were normal. Life was normal. There were no zombies walking around. It was I call it, the zombie apocalypse, right? So it was kind of a normal environment, status quo, nothing crazy. When COVID happened, let's say March, right, of 2020, when it really came to fruition, with it, people started getting furloughed and all of that. There was, kind of in my mind, I went to battle stations in my mind, because I had a little flashback to, December of 2007, and because you don't know how the market's going to react, you don't know what's going to happen. And so my advice at that moment to everybody in earshot was, batten down the hatches, make sure you're in a sustainable position. I'm a Floridian, so, we can say hunker down, which is what we do during a hurricane that we don't evacuate for, right? Board up the windows, whatever you got to do. And then slowly, within, I don't know, by late spring, early summer, things started to stabilize, right? We realized, okay, the world didn't end, and interest rates started plummeting, and that was financial decisions. The Federal Reserve have two knobs, right? With liquidity, where they can quantitative easing and quantitative tightening, and that's just how much money they print in the basement of the White House and how much they shred. And it's literally that, how much money they put on the street, in an oversimplification, right? And then they have the Fed funds rate. Well, so they kind of pegged those knobs, right? Dropped the rate, and started printing money real fast. And so all of a sudden there was all this free, cheap, easy money. Commercial rates went down significantly, and residential rates, obviously everybody knows what happened there. Everybody with a 2.5-3% interest rate on their house. So it was a boom in that sense, and it created a feeding frenzy, but it created some unexpected problems. One is on the commercial side, which I think is the biggest concern I have for our current situation. Commercial rates are always based on the property cash flow, right? If you look at an office building and you say, what's this worth? It's not like a house where they just, this is my house, I'm living in it, and I know it's worth, 1.5 million, and, the price went up because whatever. Commercial is always based on how does that property cash flow. So I own an office building and I can collect X in rent. Well, then there's just formulaic determination of the value. Well, the problem is when money's super cheap and the commercial lending guidelines were standard, were normal, people got over leveraged in like office buildings, that sort of thing, right? My rate is low. That increases the value because the property cash flows better. Fast forward post COVID now, fast forward to Silicon Valley Bank as a kind of a benchmark, right? Last year, little bank exploded, and all of the regional and smaller banks in this country, which is a lot of the commercial money comes from, said, oh crap, we better tighten up because we don't want Uncle Sam to come in and take over or force a merger or, hope that we're going to get a bailout or something like that. So they tightened up their lending guidelines. And in the meantime, interest rates were moving up, right? Because interest rates move up in response often to inflation. So we had inflationary pressure, interest rates moved up. So now all of a sudden that office building that, let's pretend it's, it has a $1 million loan on it. Now all of a sudden with a 7 to 9% commercial interest rate, occupancy is lower, there's more vacancies, that maybe they can't, that $1 million loan, no bank will give them more than 600,000. Refi commercial loans are written as a balloon, a 3, 5, 7 year balloon. So now we have a growing default of performing loans. They're still making their payments, but technically they're in default. And so that's the alarm bell that we're seeing kind of in today's economy, in today's environment, that we all need to kind of keep an eye on. Residential is more resilient of a market because people got to live somewhere. But COVID taught us one thing: we can work from home. We can work from home in our home office just as efficiently as we can work from an office space. So commercial office leases have trended downward, even more so in some of the, big areas. Retail, because there's so many, on-demand deliverable shopping systems that we all learned during COVID. Let's do, whatever. I don't want to say Amazon, but I guess I'll say Amazon and, Temu and all these other things have started to change the way people shop. So that's a concern. I think residential is going to be the anchor for our economy. Demand hasn't slowed down terribly. I mean, there's a little bit of a slowdown, but there's still a shortage in most metropolitan area, most areas. There's a housing shortage. There's an affordable housing shortage, which is a huge issue. And that's not low income housing. I'm just talking about affordable housing, for school teachers, firefighters, and, plumbers are having a hard time finding that, whatever the price range is in any given market. In Central Florida, that's the, 300,000 to 400,000 range. There's a shortage of houses in that range, and they're still selling fairly fast. So I don't know if that answered your question or if I went down a rabbit hole, but there's a lot of dynamics in the market today that are, I think, being misinterpreted. People think there's going to be a housing crash or a housing bubble because they're flashing back to 2007 or 8. It's a very different market. There's a lot of equity in houses. There's a lot of, the lending guidelines have been much tighter through the 2000s, than they were in the early 2000s, where people were getting 100% financing with no income verification and things like that. Now, people that are in a house are typically really qualified for that house. And on average, they have, maybe triple the amount of equity that homeowners had in 2007 when the market corrected. Let's call it that. It was a liquidity crisis, not a housing crash. So don't know if I answered your question, Jason, or if I went down a rabbit hole, but that's my opinion.
No, listen, I love asking questions that really don't have a direction, because it's, you're in this every day. And I think you highlighted some things that really are important and critical. for us as consumers to think about. Certainly on the commercial side, understanding the correlation between rates and value. We don't tend to look at home prices around the rate of mortgage versus the value. It's unrelated. But in commercial, right, we tend to think of commercial as like office buildings, but apartment buildings are considered commercial, right? And apartment buildings are probably, I would say, the number one place for affordable housing in any sort of residential environment, even though it's considered a commercial loan. And so, there are a lot of questions. And as these rates reset in 24 and 25, are they going to be able to get the value out of them to truly refinance? And will the rates being up and the cap rates being, changing, will those cause issues? So yeah, a lot to watch. And then, what's its impact on the Silicon Valleys of the world and these regional lenders that hold a lot of this paper. Those are all dominoes. And I think, when you talk about economics, dominoes are going to fall, right? That it just happens, and everything's on some cycle, whether it's forecastable or not. Nothing goes up forever, right? I'm reminded of a guy I had a lot of respect for. He was a financer type individual, packaged up a lot of investment deals. And he said, just remember one thing about investing in money. He said, it's the best advice I ever got. It's like when you were a kid and you stood around with your friends and you guys all put as much Big League Chew or bubble gum or whatever it was into your mouth and blew bubbles. He said, there's just one thing that happened every single time, and that is the bubble popped. And he said, sometimes they got really big and burst and it was a mess. Sometimes they didn't get that big and kind of slowly let out air. He said, but you can learn a lot from just the different type of bubbles that all your friends, blew with their bubble gum and the way that they all kind of came back. And then you chew it back up and you blow another bubble, right? And the bubble may look differently next time. And so I kind of can't help but keep going back to that is, I don't know whether the bubble's going to burst, right? And we're going to have gum everywhere, or whether it is going to slowly leak air and then kind of put itself back together. But I think anytime you're in economics and dealing with finance and money and market conditions, especially when you've got, I won't call it manipulation, but you've got people with levers, and I love your analogy, right? Turning them, you never quite know what's going to happen. And so it's important to make sure that you're aware of it, and then using that to shape your investment strategy going forward. Because one thing, and we'll kind of wrap this up with this comment, is you can't wait for economic cycles by sitting on the sideline, right? You can temporarily pause, right? Hey, I'm going to step aside and figure this out. But there are people that have been sitting in cash for 4 years because they just assumed a bubble was going to break, and you can't time the market. And we'll talk about that in the second half of our show today. And I love where we're going. We're going to take a quick break over to Quirky Questions of the Day. My favorite part. I love putting people on the hot seat and hearing what our readers are submitting. Amy is bringing them over. We're going to go top envelope today. Thank you, Amy. Remember, you can submit your quirky questions to allaboutAlts@NuViewTrust.com and keep those coming. But we're going to, let's get right to it, and then let's close the show out with some talk about private lending and what people are doing today. All right, Michael, you ready?
I'm ready. Bring it on.
All right. If you could instantly learn to play any musical instrument, which one are you choosing?
Acoustic guitar, because girls always like that.
Good answer.
And my son is an
good
incredible
answer.
Guitar player, and he has tried to teach me, and these fingers just don't do the right stuff. So,
well, I am convinced with music that that is a both skill-based talent and a God-given talent. And fortunately, for some they got it. Unfortunately for me, there is not a single shred of musical talent in anything I do. But I'm with you. I would love to just pull out a guitar one time and just start playing. Everybody loves it, which is super cool. All right. Are you going breakfast for dinner or dinner for breakfast?
Breakfast, always. I'm a breakfast. I'll eat an omelet all the time, but I might put a piece of steak with my omelet. So I don't know. Maybe that's a mix.
Interesting. So you're going both, but if you've got, you're going to put eggs with more meals than steak.
Probably.
All right. Question 3. Would you rather have the ability to speak every language fluently or communicate with animals?
Wow. Every language fluently or communicate with animals. I mean, well, I'm trying to think of a way to say it. Like, animals have their own language. So if I said every language fluently, maybe I could also communicate with animals. But I'm a lover of languages. I speak English. I speak hillbilly, which is what I grew up speaking. I speak Spanish pretty fluently, and was for a while. It's been 30 years, but when I was in the military, I actually had a language code. I spoke conversational Mandarin. I guess I probably have to lean on the language thing because I do love.
Well, I love that question because it really drives to, would you rather talk to every human or would you rather talk to every animal? And, it depends on the day for me. Some days I'm just over talking to humans and I think animals. But then again, I suppose if we talk to animals, we'd get over that process too. But all right. You're off the hot seat, Michael. Thank you guys for submitting your questions, and we'll get back to kind of where we just quickly dropped off there. And I think some of the more regular listeners of the show know, I love private lending. I started doing private lending almost 20 years ago, and I've lent through all market cycles. I lent when things were good and bad, and I lent when interest rates were high and low. But the one constant that I came back to is I love the asset class because, in my opinion, it's one of the few things that can have a fixed rate of return. And I say fixed, not guaranteed. You know what it is up front. And then you can also dial up or dial down your collateral, right? It's like having this ability to say, I want to be more protected, or I'm willing to be less protected. And you can see a correlation between that risk along with the reward, which is interest rates. So absolutely love private lending. I know that's a big piece of your business, something that you've been doing for a long time. Maybe just at a high level, and we use the terms private money and hard money. Some of that's a little bit of jargon, right? But just for the average person listening that doesn't know the difference, what's the difference between a traditional loan and a private or hard money loan?
Great question. And there's a lot of confusion, and I speak with a lot of mortgage professionals all over the country in some of the workshops that I give. And truthfully, many times they're confused as well. So obviously the layperson has every right to be confused. And so the first thing, there's traditional mortgages, or what we would call a qualified mortgage. And there's some very specific definitions associated with that I'm not going to bore you with the nuances. But a qualified mortgage, think of it as your conventional or your government, like FHA, USDA, VA loan, used to purchase a house that you're going to live in for the most part. And they're fixed rate. They have no negative amortization and things like that. So it's kind of a normal mortgage. That's a conventional government qualified mortgage. You're seeing, if you remember back to 06, 07, 05, there were all these, we called them subprime or alt A mortgages back then. That's kind of grown back, not so much in the subprime world, but kind of the equivalent of alt A today is non-QM. And again, and these are non-qualified mortgages, which could be alternative income documentation. Maybe we're using bank statements, their deposits averaged out over a period of time, modified by a factor, right? So they deposited an average of $10,000 a month. They're self-employed. We're going to use 50% of those deposits to calculate their income. That's kind of a non-QM, or what we used to call alt A, or alternative, mortgages. So those are typically still traditional mortgages. They're offered by banks or lenders, big mortgage companies that have their box and they get their money. They're originated by people who work for the bank, people who work for the lender, or mortgage brokers that represent those institutions or represent the client to those institutions. That's traditional mortgages. Now, going down into what's a private mortgage is something you typically hear in lending, investment lending or commercial lending. And truly, by definition, and so there's a little bit of a misnomer here that happens. A private lending comes from a non-bank owned lending institution. So I make the differentiation. institutional private lenders, and those are companies. Often they may have a hedge fund behind them, or warehouse lines, or a family trust that they're representing, and they are more truly a lender. They're, they have a website, they have a closing department, sometimes things like that, right? That's institutional private lending. And then I think obviously what you and I are more talking about is what I would call non-institutional private lending, which is, in some cases, it's a company like mine going to a guy like Jason and saying, hey, got this deal. Are you interested in funding it? Here's the parameters and the terms. And in that case, you're funding the deal. And maybe a company like MoneyStream Financial is representing you and arranging and packaging the loan for the borrower, servicing it and that sort of thing, and paying the return. True private lending is, hey, Uncle Henry, can I get some money? And, and he participates in that deal. And so it's a spectrum. There's not a clear cut, in my opinion, not a clear cut specific definition. It's more, a spectrum, so when we talk about institutional private lending, these are programs and guidelines and, standard matrices, product matrix and things like that. We do arrange those loans. So we represent, commercial lending institutions. We represent, small business administration, so on and so forth. We represent those loans, arrange those loans, sell those loans, package them, so on and so forth. But on the private side, what we call, just because it gets so confusing, even for us, who is this? This is a private lender. So rather than, so a Jason of the world says, hey man, I got X number of dollars, something like this. And we say, man, I'd love to partner with you on these transactions. So we call them a funding partner. And so that's our nomenclature. A person who, maybe they have some self-directed funds, or they just, they got money in the bank and they say, yeah, I'd like to invest. I've got, $500,000, or I've got $2 million. And then what we do in conversation, we'll say, all right, how do you feel about loan sizes? If you've got $500,000, do you want to bang that out in one deal, or are you looking for, splitting that up as many deals as possible? What's your risk tolerance? What kind of returns are you looking for? And then as we, let's call it intake. It's not a mechanical process. Individuals, people are different. Everybody has their own, decision-making matrix. And, we'll talk about, what are you comfortable with? What do you like? What's your goal? I have some private, I've got a guy in California who will lend pretty much anywhere except California. He doesn't want to lend in California, and he lives there. He's, and he'll do, we've been working together for many years, and he's fairly aggressive in what he's willing to tolerate. And, we put the brakes on and the safety measures in place, of course, but I know his box, and I can look at a scenario and say, yeah, you know what? This particular person would be a good fit for that scenario. We have other people who, maybe they don't like to lend in certain states, or they don't like certain property classes. Most of the private lending, I think probably the most popular and most plentiful is single family residential fix and flip loans, which sometimes people call a hard money loan. And again, it's can be a nebulous description, right? Hard money typically is what we would call asset-based lending. Okay. So when someone says a hard money loan, typically what they're talking about is asset-based lending. So we're not necessarily looking at their income, their W-2s and pay stubs. We're not doing a deep financial analysis on the borrower. We're looking at the property, and we're using equity in that property as a big part of the security. Now, when we underwrite a hard money loan, we're not typically saying, hey, sign here, you're good. We're underwriting their experience. We're underwriting the value of the property, their plan, their exit strategy. right? So we're going to look at it, and Jason's going to come to me and say, hey, I got this fix and flip, and here's the property address. And, okay, so when it's fixed, what's it going to be worth? And we evaluate that. Maybe we do an appraisal or a broker's pricing opinion. We're going to vet those numbers. Okay, here's what he's buying it for. He's going to put this amount in it. Does that make sense? $100,000. I'm going to put $50,000 into it, and I'm saying it's going to be worth $500,000. Are there other properties in the neighborhood that are going to be worth that? Does it make sense based on the square footage, the bed, bath count, et cetera? And so we underwrite that process, and we ensure that we have sufficient equity, to make the deal make sense.
Well, I appreciate you kind of walking through that. And I think it's a very hard question to answer. Not because they're so inherently different. It's because there's so many similarities. What attracted me to private lending and hard money lending, and certainly, those terms can be interchangeably used sometimes, or they mean different things to different people. I try to look at it, and when I talk to people, in my circle of influences, it's a loan that most traditional lenders don't want to write because it doesn't fit into their box, right? Do you make enough money to pay the mortgage? Can I validate your income? You make $8,000 a month, the mortgage payment's $3,000 a month, you're not riddled with debt. It's a math formula, and that's how traditional loans work. And there's nothing wrong with that. But when you look at some of these investors, they may try to buy 8 or 10 properties. Well, certainly if you look at their income, right, especially as an investor, it's already sporadic. It's not like a paycheck that people that are employed get. And so banks say, it's not that we don't think you're good. We don't have a place for it in our process, right? And so lenders like MoneyStream fill a void because they're able to step in and say, hey, we will evaluate this on the merits of the deal as a whole. And so, I'm a big believer in lending. It's two parts, right? It's both the borrower's ability to pay, and then it's the property's ability to provide collateral. And if you think about a loan, as long as those two things are met, it really doesn't matter which side you get comfortable on, as long as the sum of both parts. And I think for lenders, traditional lenders, they want to be comfortable across the board. And what I think firms like yours, Michael, is you can find comfort, and as a result, you get to play matchmaker, right? Where you get to take Jason, my self-directed IRA funds, and let's call it a couple $100,000, and you get to go look at deals and say, hey, this deal, well, Bank of America is not going to touch it. It's not because it's a bad deal. It's because, right, here's the mechanics. And so you're able to present that to people like me and say, hey, if you want to own this loan and generate this return, and here's the risk profile, that's, to me, there is no other asset class that allows me to evaluate a deal that way. And I'm not on a soapbox for it, and I think in a self-directed account, people are free to be on the borrowing side, the lending side, the equity side, the investment side. But it is so cool to me, right? Because I get this ability for someone like Michael to say, hey, Jason, here, if you want to put $100,000 in, this is a 10% return. This is the property. This is what they're putting in. This is after repaired value. This is what we think it'll sell for. That gives a holistic picture to kind of start making some investment decisions, which is really a cool process. And let's kind of take that idea and take it a step further. Like, what does a typical residential, we'll call it hard money just for the sake of discussion. What does a typical hard money loan look like? And I know you loan in all 50 states, and you've got, we could probably do 50 different examples from state to state, but we're both in Florida. So we'll use Florida as kind of our core case. But what's that look like? If you were going to send it out to a potential investor to be on the lending side, right? What are you evaluating? What are you looking for? How do you get there? And then kind of what are you sending out that allows someone like me who's passive but wants to be a participant or a partner in the deal? What am I getting through that process? And what level of due diligence and work are you guys doing on my behalf?
It's a great question. And so, let's talk about the, first step. So we don't know everything about the deal up front. We're going to get an inquiry. And so that inquiry is typically be coming from either a mortgage broker or lender or a realtor or directly from the investor. Okay. And so let's call this a fix and flip deal. And so the first thing that is I look at one, is this going to be a potentially profitable deal? Okay. Did someone come to me and say, hey, you know what? I'll only do this if you can give us a 7% interest rate. All right, well, I'm probably not gonna, that's not gonna happen. So that wouldn't be profitable. So number one, is it profitable? Is it profitable for my funding partner, Jason? Is it profitable for us? Right. Two, is it likely that they're going to perform properly? In other words, based on their experience, based on, and some of that's maybe less concrete, right? But how many deals have they done? Is it a partnership? Is it a new guy partnered with, another investor and she's done, 23 flips, right? So we're going to look at, is it safe? And then last, we're going to say I call it the safety or the bailout. Right? If they fail, comes in place, the loan documents, and enough equity in the property to make my funding partner whole. If I'm going to say, God forbid, worst case scenario happens, are they protected? So is it profitable? Is it safe? Is it protected? I'm going to intuitively, I'll be able to sort of have an idea. At that point, we say, okay, well, let's move forward to the next step. We get a handful of simple pieces of information. I want to know the property address, what are they buying it for? What do they expect they can fix it up for, right? Their rehab budget. What's the after repaired value? So, what do they think it's going to be worth once it's sold? And these numbers, a lot of times they're coming from the investor themselves. So we may look at this deal and we may say, all right, this investor has a lot, so we're going to offer this investor a little more leverage, right? So maybe we'll do a 90% of the purchase. My personal philosophy, we always do 100% of the rehab. We give them the 90 for the purchase at closing, and it's a real estate closing. Title company, closing attorney, depending on the state, right? They're going to sign in Florida. They're going to go to a title company. They're going to close. There's title insurance policies, a closing protection letter, all of the standard documents that you would see on a traditional loan. We have a mortgage. We have a promissory note. A few things we have that you wouldn't see on a normal mortgage is we have a property use act. I'm the investor. I'm never going to live in this property, and I'm not going to use it for anything other than the intended purpose of this loan, which in this case would be a fix and flip. So no one's going to live in it, and they can't rent it out, right? And we have a personal guarantee. We're lending to the entity, and then we fund the loan. We've coordinated with the title company. Loan gets funded at closing when all the documents are signed, and we service and collect the payments. Investor says, hey, I'm ready for a draw. We have a process, an inspection process, where they're providing receipts and documentation, evidence of the work that's been done, evidence of the money that they've spent. And we then send them that draw, and then monthly payments come in. Your portion of the payment gets sent to you. Money, moves through. Oh, they're done. They're done. They put it on the market. They sell. They're selling title company, or the title company handling that sale, will contact us, request a payoff. We do that. They send us the money, and the funding partner gets their money back. So that's a very fast, simplistic version of it.
Well, I've been on that side of the equation, and I appreciate you walking us through procedurally, kind of how it looks. I think maybe to summarize for our listeners, the idea of private lending is really that you look like the bank, right? And you're relying on your own underwriting, because nobody should ever write an investment ever without doing their own underwriting, right? Nobody should trust exclusively the underwriting of others, whether it's on a loan, on a property, on a business. But ultimately, you get the ability to play the bank, and the bank does. The bank goes out and finds deals, and they make sure the deals make sense to them, and they send their money with not just hopes of getting their money back, because we want to follow one of my favorite Warren Buffett quotes is return of principal is a lot better than return on principal, right? So we don't get so lured in that we're making 11 or 12 or 20% returns that we forget that I still want my 100 grand back, right? That's critical. So as a lender, it puts you in a position to really evaluate a deal and truly become a bank. And there's a reason why if you drive into any major city, 80% of the names that are on tops of the buildings are banks. That's not by accident. That's by design. And so I love the idea of being the bank. And I love the fact that there are firms like Michael's and others that will do a lot of the heavy lifting, finding the investors, doing the first wave of underwriting, doing evaluation, negotiating, managing the paperwork. I couldn't do all those things. I don't know the first half of it. But what I love is that when that deal's packaged up and it's sent to me, I now get to do my own due diligence, whether it's a second set of due diligence, whether it's similar, whether it's validation, whether it's different. And I get to say, you know what? I really like this deal. It works for me. Or I get to say, you know what? I don't know if it's a good or bad deal, but it just doesn't fit what I'm looking for. So definitely a really fun place to be. And I think a lot of people, they kind of think that being a lender is daunting. And I think if you're going to do it alone, it probably is, right? It takes a long time to understand how it works. But working through people that can help find and vet those loans and do some underwriting is a real game changer. So I couldn't encourage you guys that are thinking about getting into the lending space to really take a look at it. Talk to people like Michael or firms like his and find good partners and people that can help underwrite and do some of the identification and due diligence to at least get a deal onto the table. So from a time standpoint, we have covered so much. We've elapsed our overall time. So we'll bring today to a close. Michael, thank you for your time and your wisdom today. We'll make sure all your contact info is in the show notes. So if anyone does want to reach out to you and ask any further questions or your firm, they'll be able to do so. Michael, last question, and this is something we ask as part of our season 2. Every single person before we let them off the show completely. This is just a personal question for you. Answer it any way you want. But Michael, help us. What keeps you up at night?
I think everybody has responsibilities, right? I'm the kind of person, and I was actually just speaking with my 19-year-old son about this yesterday. I worry about other people first, and it's a mentality. I don't know if you want to call it empathy but what would keep me up at night would be, making sure or the risk or the concern about, my employees' families being provided for, my funding partners, having success with their investments, our clients, our borrowers, the people who trust us, so for me, and maybe this was genetically implanted in me, as part of being an infantry Marine, you ask someone who they fight for. Someone who's been in combat, and I've been in combat. Someone, you ask, oh, are you fighting because you're patriotic? Are you, what? At the end of the day, you're fighting for the people around you. That's you're, and so for me, I think that's my keep me awake at night is making sure that I'm providing the very best and the safest and the, whether it's their goals of retirement or, providing for their family, that the people who I'm blessed to be surrounded with, whether they're clients or borrowers or, or my staff, my team, so making sure that I am giving them the very best of me.
Well, that is it's an interesting philosophy and one that is amazing when you hear the stories of how your whether it be your upbringing, your time in the Marines, how that does carry forward and stays with you in both your personal and professional life. So thank you for sharing that, Michael. You have been fantastic. Learned a lot. Appreciate having you here today, and look forward to having you on the show again.
Awesome. Thank you so much, Jason. And I appreciate you. And obviously I appreciate Amy and your team.
Well, we appreciate that. And to our listeners, thank you for being here. We're glad to have you and look forward to keeping you on the podcast train and listening to future episodes. If there's feedback or if there's topics that you guys would like to hear, be sure to send that to allaboutAlts@NuViewTrust.com. Hit the like, share, subscribe button, leave us a review, all that good stuff. But we love having you, and we'll continue to keep educating as best we can on how to be a good investor, find good strategies, and save as much as you can on taxes through the process. We'll see you guys next week. Thanks again.
Thank you so much for listening. We hope the information within this podcast has given you the tools that you need to find your way to financial independence. We would love to partner with you on this journey. Text ALTS, that's ALTS, to 407-708-1853 to learn more about how to get started today. Don't forget to follow us to make sure you don't miss a second of content, and we'll see you next week.